It's recording a screen share we've got.
Yeah, just 1 second. It's the same one as before, right?
It's the screen share, yeah, the presentation, Family Office Insights, Arthur Bavelis. Forgot to charge it.
That's to be connected.
Hi, Arthur.
Hey there.
How are you?
Doing good, thanks. How you guys doing? All good in your world? Can you hear me all right?
Full group from our team over here. They're just gathering.
Yeah, I can hear you fine. Can you hear me? Here. Can you hear me all right?
Testing the sound.
I can hear you.
Should I be on live?
Can you hear me or no?
Probably this way. Okay. Oh.
Hi.
Hi, Arthur. Can you hear us?
Yes, but you apparently can't hear me.
Then it must be this one. Test. Testing.
I can hear you.
Oh, perfect.
Okay.
Yeah.
Is that all right now?
Yeah.
Is there a delay or you can hear me?
Yeah, we
can hear you perfectly.
Okay.
Yeah, no, that's awesome.
Good.
We're just gonna get the same presentation set up here.
How are you guys making out?
In terms of so we've had a couple of follow-up calls with prospective investors. We haven't had any come through yet and actually commit to the deal, Arthur. So we're still we know it's a challenging time in some ways, obviously. And so we are getting that feedback from people, but haven't had any come through and commit to the deal through one of our webinars quite yet.
How about the other folks that you're talking to?
Yeah, in terms of the broader capital raise, well, we've got the two deals. One, the development deals really slowed down in terms of the capital raise velocity there. We were pretty fast mid-summer of 2022, obviously, and it really dropped with interest rates and with general volatility in the market. So we've still got 2.3 million remaining of 17 million total on that deal. And I think that at this point in time, it's almost a story where it'll be a lot easier story once we have vertical construction and steel going up on the site.
Yeah.
Versus where we're at now, which is having spent a lot of money, done a lot of site work, but don't really have a building superstructure to show for it. And then on the value add side, that deal has been a much easier raise. So I think we've had about 10 new investors of about 40 total in 2023. And we're down to something like 400,000 or so remaining today to close that equity raise, with the possibility that if there were significant appetite for more, we do have some ability to go over and oversubscribe that slightly. So call it, around $1 million of availability, or so, 400 of open subscription remaining on the value add deal.
Yeah. So as you might guess,
Oh, you're going to be on their side.
some of the feedback that just happened in the process of promoting people to get on here.
Yeah.
We did get some. It had nothing to do with you. It just had to do with Silicon Valley Bank, Signature Bank.
No, I get it. Yeah, no.
Bank, all that stuff that was going on, and of course the prognosticators are talking about real estate. So we just got a little pushback and saying, yeah, what not pushback about you. I don't want you to take it that way, because that's not what it was. It was just about real estate, right?
Yeah, and it's a tough thing to try to make a very clear distinction in investors' mind between what we view as more speculative real estate markets, places like Arizona or Texas that have built very, very, very quickly in response to increased demand, and a place like Boston Metro where it's just much harder to add new supply, and demand is, and there's such pent up demand already in the market from higher education and healthcare. So I mean, we keep kind of beating the same drum, and it's really a process of trying to explain how different Boston is from a lot of other real estate markets. I think people have, with bank crisis, certainly they had flashbacks of 2008, 2009. Yeah. And I'm sure they're imagining in the back of their mind, The Big Short, if you saw that movie, and people knocking on doors of apartment communities in Florida that were built speculatively and never had a tenant in them. Yeah. And it's so different in Boston, one, and so different in Boston today, too, that it's just that it's a distinction. We just, we don't want people to look at real estate and say, oh, we're, building on spec, something that it's like we're in a market that's tremendously undersupplied in.
Okay, welcome everybody. My computer's fan is spinning, so maybe it's struggling a little bit here. But welcome everybody. Thanks for joining with us today. We are fortunate and honored to have, I said it wrong last time, Helge Capital. I watched some sort of TV series and Helga was in there, so that's what stuck in my head. So thanks again for being here. We're going to dig a little deeper today and talk more about the details of the real estate opportunity in Boston. As many of you know, I think it's since 2014, you guys have deployed over $400 million into Boston-centric area real estate. And correct. So we're anxious to hear more about the details of that. For everybody that's coming in today, we can see that you're there, and we encourage you to ask your questions via the chat box of the Q&A, and post them as they come to mind. We have a bunch of folks coming on today, so we'll get to as many as possible, but don't hesitate to put them in the chat box in the Q&A as you think of them. And then also, if after you hear the presentation today, you want to review it, we'll be posting it to the Family Office Insights YouTube channel and or the company website. And so please feel free to share it with others, and as well as feel super comfortable in contacting Chris and his colleagues there directly, and we'll make sure that we facilitate that so you're all in contact with each other. So we are broadcasting live from Brooklyn, New York, and Boston. And so again, thank you all for being with us today. And we look forward to hearing from you, Chris, and your colleagues again. Thank you for joining us.
Thank you, Arthur. We're very excited to be presenting again to the Vivelis Group and the Family Office Insights community. We spoke earlier this month, and since then, and also at the end of last year, and since then we've continued to make tremendous progress on both of our current projects, both our ground-up development at 93 Bennington Street in Revere, as well as our value-add project at 190 North Shore Road in Revere as well. So by way of introduction, my name is Chris. I'm joined today by Oleg Uritsky, CEO and founder of Helge Capital, John Gosnell, leading our operations and capital markets team, Darren Nolette, heading up our finance team, as well as Nikolai Yinger in operations and capital markets. So by way of agenda, first we'll provide an introduction to Helge Capital for those of you who don't know us, our history, who we are, what we do. Then we'll offer a brief outline of the Boston Metro multifamily market, a quick sketch around why we like it. Then we'll dive into Revere specifically. And so Revere is located directly north of Boston. It's a very vital corridor, and we'll explain why we're so excited about that particular area of the Boston Metro at this moment in time. And then finally, we'll discuss our current development and value-add investment opportunities in the city of Revere, and talk more about how you could find out more or set up a future call if you were interested and it matched your investment priorities. So our goal through 2022 and now through the first quarter of 2023, it's been to both broaden and deepen our investor base with an aim towards establishing programmatic long-term investing partnerships with like-minded family offices. And so we're very much looking forward to getting to know many of the people, many of the offices on the call today. More than happy to schedule personal follow-up calls, dive into our strategy in more depth, talk through our current projects, and answer any questions you might have. And hope that if our strategy does align with your investment priorities, that you really don't hesitate to reach out. We'd love to talk with you. So in terms of a background on Helge Capital, we're founded by a successful Boston-based entrepreneur. That's Oleg here in the room with me today, who previously started, ran, and sold transportation and healthcare companies. Since 2014, as Arthur mentioned, the exclusive focus here has been on building, managing a Boston Metro real estate portfolio. And during that time, we've assembled a highly experienced, highly capable team and built a vertically integrated firm that touches all aspects of real estate, from asset management to property management to leasing. Over that time as well, we've achieved an impressive track record, acquiring over 400 million of real estate across 22 acquisitions, and have successfully completed 10 exits, generating a 26% IRR for equity, which represents over $122 million in dispositions. And we've really honed a specialty, we feel, in identifying and investing in multifamily assets, specifically within emerging neighborhoods of Boston. So if we fast forward to today, we're a focused sponsor, both by our geography and our asset type. We're exclusively focused on the Boston Metro, and within the Boston Metro, we exclusively focus on multifamily real estate. So we think our concentration on that particular niche, our specialization, really sets us apart from a lot of other sponsors you might see. Within this focus, we actively pursue two strategies: opportunistic development and also value add projects. So regardless of the strategy, we own and develop what can be called workforce housing. We don't buy trophy assets or build to the ultra high-end, flashiest luxury product in the market. What we really strive for is a value proposition for our tenants and really well-located sites. We also invest substantial personal capital alongside our investor partners in every deal we do. And in both of the deals we'll talk about today, internal capital from Helge principals and employees is over 30% of the equity. It's another key differentiator for us. I've looked at a number of these presentations, and I rarely see, if ever, a number higher than that in terms of skin in the game. In terms of Helge's other investors, we work with a number of family offices, high net worth individuals, many of whom have actually done multiple deals with us over the years. They know and like Boston. They know what we deliver, and they're happy to continue to roll that investment forward in a market they really believe in. On the current deals that we'll talk about today, we actually have committed investments, committed funded investments from 50 of such entities. And again, many of them have invested in multiple deals. So as an investor, you're coming into a very well-established group. In terms of the future, our outlook is that we want to continue to build our expertise and actively pursue our dual strategies of opportunistic development and value-add multifamily throughout Boston emerging neighborhoods. We don't intend to go out and have our focus shift to another geography or another asset class. Boston multifamily is what we do. It's what we look at, live and breathe every day. So we will remain a high conviction, disciplined, quality over quantity sponsor that targets doing 3 to 4 new deals per year, of course, depending on the market conditions and the opportunities that we see. And we just note, as we start to get into 2023, we're actively in the market, looking at deals, touring potential acquisitions. And we really think that our 2022, our history of success, but also really our strong growth as a firm over the last few years has expanded our opportunity pipeline dramatically. And so it's a key point that the more active you are, the more opportunities you see and look at, the more credibility you earn among the local real estate market participants. It builds upon itself. And so 2022 was a pivotal year for us since we broke ground or acquired over $90 million of multifamily projects in the Boston metro. So, but with that growing, with that expansion, with that new opportunity set, it comes a need for capital. And, that really brings us to our purpose for today, which is actively building long-term relationships with like-minded family offices. And our goal is always not to do one investment together, but it's really to develop into a programmatic investment partnership that grows and thrives over time. So taking a step back for those unfamiliar with Boston, we have to sometimes remind ourselves that not everyone lives and breathes the market every day like we do with the same level of focus. Boston faces a real structural undersupply of housing, more so even we think than many other places around the country. Supply is persistently more below demand. And it's the case we think today more than ever. And why? On the supply side, we see high barriers to entry. So zoning restrictions, slow municipal permitting process, existing density of housing stock, scarcity of well-located, undeveloped land, and expensive local construction all slow down the pace at which new units are added in Boston. It really stands in stark contrast, we think, to some of the markets in which housing's boomed recently, in which we've heard positive feedback from investors, like Texas, Florida, Arizona. Those are great markets when they're hot, but given that supply can be added much more freely and quickly to meet new demand, we question what happens if demand does ebb. At the same time, in Boston, we see very high demand, very stable demand for housing. And our belief, and I think this is borne out, is that it's really underpinned by world-leading recession-resistant industries such as life sciences, biotech, healthcare, and higher education, in which Boston is really a world leader, and pulls capital into those industries, whether in the form of students' tuitions or federal grants from around the country and really from around the world. And we note that these are generally high skills, high paying jobs, industries that are not mobile or cyclical. I know many people have heard about layoffs in technology companies like Facebook or Google, and or this phenomenon of workers moving from higher cost markets to lower cost markets because they're able to work entirely remotely. When it comes to a hospital or a university, I think it's proven that those things exist where they exist and people come to them. So, of course, I know Arthur's mentioned in the past, Boston has a strong presence in financial services and tech as well. Those are great fields as well that Boston is a leader in and punches well above its weight. But we really look at the key differentiators as life sciences, biotech, healthcare, and higher education. And importantly, a 50% retention rate of greater Boston area students after college has led to a population increase of over 10% in the last decade. And, we continue to think that the best and brightest students from our Boston schools will want to live and work in the Boston area after graduation, because there are great opportunities here. And I wanted to put it in greater context as well, with this why Boston, why multifamily line of thinking is, the dramatic recent rise in interest rates and what that's done to affordability of home ownership in Boston. Boston's a high cost area to buy a home. And we think that the recent rise in interest rates, it's actually positions multifamily very, very well to steadily raise rents. And it's especially the case considering what has been, even during a period of potential slowdown like we've seen, really a relatively robust local employment and wage outlook. So to take a step back, and put some more context on it, the average home price in Boston Metro, somewhere between 700, 800,000. I mean, it fluctuates, but it starts to really make a 2-bedroom apartment rent of $3,000 or even $3,500 look extremely reasonable. When you take the rough numbers, say 20% down, it's $160,000 down payment and interest rate of 6.75%. It starts to mean that a 30-year fixed with a monthly payment is $4,200, and that's before you start to factor in real estate taxes, insurance, or condo fees. So going even further, what does $50,400 mean in annual debt service with the tax rate and after-tax dollars? That's $72,000 of income that's required just to really pay an average Boston area mortgage with no other expenses. So just taking a rough cut of the 30% on the mortgage payment there, and looking at the total income required for a median household in Boston, it jumps to well over $170,000 to avoid being what's called housing cost burden, or what's typically referred to as housing cost burden. So all of that is a way of getting to the point that it results in many higher income renters by necessity in Boston, looking for value propositions in places like Revere, from which they can easily commute to job centers in Boston, Cambridge, and the surrounding suburbs. So it's a market we think is poised for future growth. So jumping into more detail in why Revere, it comes down to location. Revere is a key part of the Boston metro. It shares a border, as you can see on the map, with Boston. It's one of the most vital, rapidly developing corridors in our region. And with urban rents continuing to skyrocket, young professionals just graduating from Boston's universities, they're increasingly seeking relief in outer urban locations like Revere. And so Revere's 2020 to 2030 projected population growth is actually expected to be 11%. And that puts it among the very fastest in Boston metro communities. It reflects 3,000 additional households by 2030. And even when we look at new supply coming online, it's clear that apartment supply vastly lags demand. We like Revere because it's a transit-oriented community as well. Our rapid transit in Boston, it's called the MBTA, and the MBTA Blue Line cuts directly through the heart of Revere, offering reliable access to downtown Boston in minutes, and it has multiple stops. So it's an easy walk from many different points in Revere, including our assets in the community. The MBTA, there are often some news stories that come out about its issues. I will say in the Blue Line, it's a very reliable line. It's a line that's been invested in heavily, and in a number of stops along the Revere corridor, two of which you see here, Suffolk Downs and Beachmont, will be completely redeveloped and enhanced as part of the mega development occurring just next door at Suffolk Downs. And we'll talk more about Suffolk Downs shortly. Revere also offers easy and convenient auto access to Boston, Cambridge, and job centers north of Boston along the highway called Route 128. And it's a short drive, as you can see here, 5 minutes to Logan International Airport. So transit-oriented, close to an urban core is great, but we think what really sets Revere apart is its natural beauty and the recreation opportunities that are present. This is a beautiful aerial map here. You can see the very popular Revere Beach, 3.5 miles long, wide sandy beach, multiple nature reservations and parks scattered throughout the city. And in the locations that we've invested in within Revere, you can see them highlighted here. We've prioritized that proximity to parks, natural reservations, and the beach. Walkability to nature and public transit. That's a rare combination, and that's what we really look for and are the hallmarks of where we choose to invest in and commit our capital in the city. So
hey,
we
Chris,
feel it's,
Chris,
yeah, sure.
real quick, I should know this by now, and I should be able to discern this, but is the Suffolk Downs development entirely within the Boston city limits, or is it traverse Revere in any way?
Yeah, no, Suffolk Downs is actually straddles the border between Boston and Revere. It's approximately 2/3 in Boston and 1/3 in Revere.
Yeah.
So it's 160 acres that straddles that. line in the history of it was that it was actually formerly a horse racing track. And you know, when it closed, when it was purchased by its current owner, now almost 6 years ago, for a development like the one that you see rendered on the screen, you know, that they had to go through the full approval process in both Boston and Revere to get that accomplished. So yeah, so it's a good it's a great transition, Arthur. That, you know, Revere, it's a dynamic, transforming neighborhood. This is another rendering of Suffolk Downs. You can see the Boston skyline in the background. We haven't been the only ones to recognize Revere as an attractive market, as an attractive corridor of Boston. Institutional development and investment has entered the market really dramatically in the last 10 years, and we think will be even more so the case as Suffolk Downs is built over the next 10 years. So Suffolk Downs, it's the largest private development in Boston's history. It's over 160 acres. It'll be 16.2 million square feet of brand new master planned community when it's completed. And it's important to note 5.2 million square feet of that will be office and lab space. So it is truly mixed use. It's not a space that is simply residential or you know, offices. It's really a live, work, play environment. And it's not, you know, it's a great rendering on the screen, but the fact is this is under construction now and broke ground last summer. And we're excited to see that it will become a major new regional employment center. And you know, its importance, it can't be overstated to the Revere investment thesis. Other developers, you know, as you'll see on the next slide at Gibson Point, Redgate, who's done a number of very successful, built and sold a number of very successful multi-family developments on Revere Beach. We're excited to see they recently moved to the very northernmost tip of the city and broke ground on a project in 2022 in the summer of almost 300 units, a multi-family development with ground floor retail and restaurants, and that's actually right next to, you can literally see here a 3-minute walk from our value add acquisition of last year. So Suffolk Downs is certainly the anchor, certainly the big story in Revere, but it's not the only story. Development is occurring throughout from the north all the way to the south, and it's institutional development that's pushing ahead and really changing the environment in the landscape. So, you know, as I mentioned, our projects, you know, one of our key hallmarks is we're well positioned adjacent to brand new institutional developments. We look at this as very complementary, not competitive. You know, we say it's an emerging neighborhood, and investment, and particularly transformative investment, place building within it. It's a positive for us. We have our flags planted in the ground. We have our buildings, we have our sites, and we're thrilled to see that development come in around us. And I think it reflects what we've seen in many other Boston metro neighborhoods, which Nikolai can touch on next, as we'll go through several examples in Somerville, in Cambridge, and in Boston that we look at as very clear indicators of where Revere and particularly where Suffolk Downs are heading.
Yes, thank you, Chris. My name is Nikolai. I will cover a little bit about the emerging neighborhoods in the Boston area. And if you're not familiar, the first one we'll take a look at is Seaport. It's a small community next to downtown, and this is as it was in 2010. basically primarily covered in parking lots. It was a primary destination for people who were working in downtown. They would park their car in Seaport and walk across to downtown. And today it was completely transformed. It only took 12 years to build an entire community with very high rents compared to most other locations, and they've completely run out of space at this point. And it's a neighborhood that has emerged in the last 10 years. Another one we'll take a look at is Assembly Row. This is Somerville, and this is a picture of it as it was in 2010. And this one is also a transit-oriented location right on the orange line next to downtown Boston. And over the last 10 years, it has completely transformed into a community. It's a mixed use with a hospital and many commercial spaces, as well as multifamily residential real estate locations.
Yeah, we actually think Assembly Row may in some ways be most analogous to Suffolk Downs, and would note that the developer of Suffolk Downs, HYM, agrees and puts Assembly Row directly on their website as what they're striving to create with Suffolk Downs.
So as you can see, it's a completely different scene as it was in 2010. And many neighborhoods like this continue popping up around Boston with institutional capital entering the area. Many companies are also positioning themselves as institutional adjacent. For example, we can take a look at Alewife in Cambridge. Cambridge is just north of Boston. It's a city across the river, and it is home to Harvard and MIT. And this city here is a transit-oriented, just like Revere on the red line. The previous one was on the orange line. This one is on the red line, and Revere is on the blue line. And over the last 10 years, Alewife has also completely transformed into a brand new neighborhood with many mixed use and multifamily residential buildings coming up. And they're finalizing their development probably within the next 3 years or so.
So Nikolai and guys, in the uninformed like me, looking at this and seeing how these developments have consumed those spaces in the Seaport and the one where everybody was parking, that it absorbed a lot of the demand, but there's still, maybe you can talk about that. In a short period of time, they built all this mixed use, arguably, so there was some residential in there, and so it absorbed some of the demand. Is it still heavy in demand, independent of all that building?
Yeah, absolutely, Arthur. We think Boston Metro in general, despite this development's actually quite undersupplied in terms of housing, and in terms of biotech and life science space. And that's kind of a theme of all of these neighborhoods is really three things. One is that they're all transit oriented. Two is that they all have a very, very large anchor developer. In each case, Davis Companies in Alewife, WS Development in the Seaport, Federal Realty Trust in Somerville and Assembly Row, and that they all focus on housing and lab space, and that they just simply can't build enough of it on these sites. So no, I'd say that we're not near capacity in terms of, and we're not near a point where housing has become inexpensive or oversupplied in Boston. I think it's actually pulled more people and more demand and more companies into the broader region, and may have actually bolstered demand more broadly across Boston as a whole. This continuing development. So, we look at these things as coexisting, that they're complementary, not competitive. That Alewife and Assembly Row and Seaport, that they're they're kind of earlier stories of what we'll see occur in Suffolk Downs, not developments that have met all of the demand that there ever will be in Boston, and that suddenly, you know, we're done building in Boston. I don't think that's the case. It's a slow process, but it's an ongoing process, and we're still we think well undersupplied.
Great, that's super helpful.
It's also important to understand that Boston is an educational hub with universities like Harvard and MIT, Boston University, Northeastern University. They are attracting, they're also building more additions to their campus and attracting more students. And those students are attracting more institutional capital to be invested into these life sciences sectors and healthcare sectors in Boston as well, increasing the job market in the area.
Yeah, totally makes sense.
So another one we'll take a look at here is Revere Beach. This is on the northern end of Revere, between our two properties, Sora and 190 North Shore. This is an image of 2013 Revere. You can see it was a large park there with parking lots. And today, those parking lots once again have turned into mixed use and multifamily developments all along the beach here. Next one we'll take a look at is our development. We built this one in 2019 and through 2020. This is 90 Ocean Avenue on the southern end of Revere Beach. And here it is in 2022, right next to another building called The Ryder, which was acquired by institutional investor Investco in 2022, in June 2022.
Hang on, which one's your building?
The gray one.
In the center of the screen there, Arthur.
The one closest to us, not the beach.
Correct.
Gotcha. Okay.
It's all very, very proximate to the beach, but yes, that one. Correct.
Yeah, I knew that, but I'm not sure everybody else did. So thanks.
Oh, sure.
Yeah.
Yeah. So, and that's a great segue. That's 75 units, ground up construction, completed and stabilized in 2021. And it's a great segue to the project which we're raising capital for today, which is called Sora Revere, located at 93 Bennington Street, just a half-mile south of 90 Ocean Avenue. So 90 Ocean Avenue was a tremendous success for Helge, tremendous success for our investors. As you can see there, the results really speak for themselves. And that's what we're looking to replicate on an even larger scale just south at Sora. So when we talk about Sora, and on the next page, you can see just how close it is to Suffolk Downs. The business plans was to opportunistically assemble and permit parcels directly adjacent to Suffolk Downs before Suffolk Downs became an under construction known construction site. Now we're building today. Suffolk Downs, HYM is building today. We're thrilled and we're excited to be adjacent to the largest private development in Boston's history. But when we're assembling this, it looked very much like it does in the map here. Empty parcel, empty land, waiting for redevelopment, waiting for investment. So we acquired and assembled that next to Suffolk Downs just prior to that project breaking ground. We plan a 5-year hold here, complete construction and lease up, follow the same game plan as 90O, the 75-unit ground up project completed just up the road in 2021. And then at that point in time, assess where we're at, whether it's the right time to sell, to refinance, based on the trajectory of the overall neighborhood in Suffolk Downs as a development. So it bears repeating. It's as you can see there, it's an extremely rare parcel of land to be developable in this size, based on the fact that it's both walkable to public transit, 4-minute walk to 2 different rapid transit stops, which you can get to Boston in 10 minutes, 15 minutes on the train, as well as to Revere Beach. So we think to have the ability to offer a tenant the opportunity to take a train into work in 15 minutes, or to go for a jog along the beach after work, 10 minutes away. It's just a really unique value proposition to offer all that at $1,000 less than rents in downtown Boston, for brand new construction. So we'll be building we're in the process of building 114 units there today. It's 100% market rate, which is worth noting, because if we were just 500 feet south in Boston, we would have to have built this at a 13% affordable requirement. So Revere's very development, I'd say very, very encouraging of development in its communities. It recognizes the need for more housing. And so we think of it as the best of both worlds in many ways, to have a Revere address, a Revere development, with direct exposure and access to Boston.
Is that rare for them to have it so you don't have a allocation towards affordable housing?
It's not a requirement in Revere.
Yeah,
but it is in Boston. In Boston, it's 13%.
Yeah.
From now on, it is, so it's pretty much doesn't exist anymore.
Yeah, it's a unique opportunity, and I mean, especially in a market where the focus is on emerging neighborhood growing rents, to be able to have that ability to raise rents across 100% of your portfolio, across 100% of your units, rather than say 87% of your units, that makes a big difference in terms of the bottom line. If we were to pick this building up and put it in Boston, it wouldn't pencil out or financially be as strong as we think it will be.
It's a huge friction.
Yeah,
I'm not making a moral, political, or whatever woke statement about it. I'm just saying that, I know what a drag on return on investment can be if you have to artificially support the rents, right?
It can absolutely make the difference between a project going forward or not.
Yeah.
You see that firsthand every day, and totally get that. Yeah. So we're very excited though with where we're at. And today, it's well underway. We broke ground this past summer. We completed driving piles for this development site at the end of last year in December. We'll be going vertical with steel framing shortly. So overall, it's a very good time to come into the project, especially a development project like this, where a lot of the big unknowns with a development, they come early on in the process, right? Getting the project fully entitled, getting the financing in place, finding the general contractor, agreeing to a guaranteed maximum price contractor or other contract for that matter with that GC, getting under construction. In this case, all of those things are behind us. And we're at a point where the project is approved, the project is permitted, the project is under construction with a local, well-known, reputable GC. And we're moving ahead towards our plan of a 2024 development. So coming in as an investor right now, you're a lot closer to the cash flows, ultimately to the sale or to the refinancing of the project, than you would have been 6 months ago, obviously. And in a 2-year window, we're now 6 months into this construction. So you can think of it as being roughly a quarter of the way through a 24-month construction process. So looking at it too, as it lines up relative to Suffolk Downs. We're always driving by Suffolk Downs, so we're keeping, of course, close tabs on what's happening there. We think the delivery in the fall of next year, it's perfect timing in terms of what will be a strong submarket overall, with emerging demand coming from new buildings also coming online, coincidentally in Suffolk Downs, right around that same timeline, both housing as well as biotech and life sciences. So we're thrilled to be part of that first wave of new construction that will be delivered next year in that neighborhood. So just highlighting that location a little bit more in more depth, because it bears repeating. It's very unique. We're 4 minutes from the MBTA Blue Line Beachmont stop. That's a 15-minute ride into downtown Boston. I've ridden that. That's an easy train ride. It's not a transfer. It's not a whole bunch of stops. And at the same time, we'll have one-to-one parking on site here. So for tenants with cars, which we'd expect they would have and have the option to have. It also offers easy access to Boston and Cambridge. One of the things we really like about this site too, the short walk to Revere Beach, it's a great aspect. But we're also sandwiched here between two very unique things. One is 40 acres of open public space and trails that'll be part of Suffolk Downs. So out of their 160 acres, 40 acres of that is new public lands, parks, that'll be publicly accessible as an amenity to the neighborhood. The other factor is that we're across the street from Belle Isle Marsh Reservation. And that actually is a reservation with hiking paths and trails, where if you look at the aerial map, you're actually overlooking the Atlantic Ocean. So we're thrilled to be specifically where we're at here. And the underwritten rents that we've got in our model for Sora, they're substantially below comparable properties in downtown Boston, which I hit upon. And to frame it similar to how I framed the housing market earlier in Boston, Boston Class A, we look at as 4,000, 4,300, 4,500 for a 2-bed in downtown, call it Fenway or Seaport or Back Bay, or downtown itself. Revere, our underwriting here is closer to 3,300 on average. And so what we look at and the way we frame it is we think about it as $1,000 a month less compared to Boston to be 15 minutes away on a train. To many, that's an extremely appealing value proposition, especially when you consider the new neighborhood that's growing around this community as we speak. And I touched on it earlier. This is 100% market rate. In Boston, it would have had 13% affordable. So, Revere, and will continue to be in Revere for investors who invest in this deal. We have others coming in Revere, and we like this market. We'll continue to be an active player in it. And I think it bears repeating that it's a closed deal. It's under construction. We're ready to go vertical. And so as of today, we're 85%, 86% raised on the total capital at Sora. And our goal is really to close that out very, very shortly. So another deal we can mention just briefly is 190 North Shore Road, and it highlights another aspect of our strategy is value add. And I think that why I want to mention it is that having both this asset in North Revere and building Bennington and South Revere, they inform one another. It's important to have both pieces of this puzzle in order to fully understand the multifamily market and the breadth of the multifamily market. So this was 72 units, 100% market rate, 5-year hold period, renovations underway as we speak. By the end of the 3rd year, we will have renovated all 72 units in common areas. And this is a very straightforward process here where we say, taking an asset with below market rents, acquiring it at an attractive price, putting in the work to improve it, to push rents higher to market, and really drive cash flow. So when we look at where we acquired this at rents under $2,300 a month, you know, we're not surprised, but we're pleased that today we're renting units for $2,950 after renovation, beating our own underwriting by close to 5% on average. So it just shows you another aspect, another asset that you know, Helge is actively participating in the Revere market, building our expertise and experience across the marketplace. Both deals, you know, they're raising capital today. Happy to take calls on them. Both deals offer high teens IRR, net to investors, approximately 2.3%, 2.3 times equity multiple over 5-year holds, 6 to 7% annualized cash distributions paid monthly. We employ conservative leverage, 60 to 70% loan to cost here. And as I mentioned earlier, you know, we've got I think an industry leading sponsor co-invest at 30% of the total equity alongside our capital partners. Every deal we try and do the same. We try and do the same deal structure and keep it straightforward and simple, and a 7% priority return of investor capital, a cash up payment to the sponsor, and then a 70-30 split. So it's a 7% priority return with a 70-30 split thereafter. And yeah, I think with that, Arthur, I don't know if there are any specific questions that have come in.
Yeah, there's a couple. I have a couple here.
Okay.
One, I just want to make sure I read it right because I thought it was super interesting. The property before this was only 5 minutes from Logan and 15-minute train ride from town. And then the Northern Revere thing is only 15 minutes to Logan, which,
Yeah.
you know.
Yeah, I mean, to say that they're 3 miles apart, right? So they're you know, we look at it, you know, in our world, it's, you know, the northern part of Revere Beach and the southern, I mean, it's Revere Beach. They're both on Revere Beach. Yeah. Yeah. They're not far apart. Very analogous market.
Yeah. And I noticed the loan to cost. I'm sorry, the replacement cost. This is the value add property that you're doing is 32% under replacement cost, which is, you know, we don't hear about those numbers, right? That's a crazy good number.
Yeah, no, that was a great deal. I think in this case we really fit into a sweet spot, Arthur, which is basically we're smaller than the, say, 50, 70, 100 million dollar acquisition for an institutional player, and we're much larger than the typical mom and pop investor that might be able to pick up 10, 15, 20 units. So picking up these assets that are right around 30, 50, 60 million dollars, we look at it as a great sweet spot for our size and scale that allows us to drive some interesting and attractive discounts to replacement cost. And actually, John had just mentioned to me on this project, it's really bears noting that you know, we acquired this in September. So we've operated and run it successfully for half a year, for 6 months now. And we'll be beginning our distributions, our monthly cash distributions in May. And that'll be 6% annualized cash distribution, starting up just in about a month. So that kind of goes into the story of it being, it's a very attractive time to come in to close an equity raise like this, where you already have traction in the market, and dividends that are committed to be paid in the near term.
So
how much really out of equity of this deal?
Yeah, so we have 400 today, with some potential, Arthur, like I was mentioning, to go slightly over that amount if there were outsized demand, but can certainly accommodate investor that's interested in coming in today, and happy to talk. So it is both these are still open and taking orders actively.
So 400 on this, and then the other one that's going to go vertical, 2.3.
Yeah, so that's 2.3. That's a larger raise. So that's out of 17 million total. We've raised about 14.7 to date. So similar percentages, still over 85% rate, 85% raise. But for an investor looking for a long-term investment in Revere, in an emerging neighborhood, wants a brand new building that'll be developed and delivered next year. That's a very attractive one.
So I know it's hard to predict, but would you, if the demand just kept on rising in the way that you look at things, would you, if you could exit this thing with a big exit check because somebody just wanted it, you're going to entertain that, right? Or are you just looking to hang on to this?
Everything's for sale, Arthur, right? So,
Yeah, I would say we like outrageous prices.
Yeah, right. Yeah.
Under them. But it has to be outrageous.
Got it. Because this looks like it's going to be a beautiful building. No friction from, supporting artificial rents. 5 minutes from the airport. It looks like it could be a keeper, right?
Yeah, absolutely. And that's something we always think through is, if this is a great asset in 5 years, the development runway for Suffolk Downs is long. That's a 10, 15, 20-year project. This could be a great candidate to refinance, take equity off the table, and continue to hold for further upside and rent growth years, in the out years after year 5. So we show it as a 5-year hold, but there's no pressure externally on us to say sell something at a time that's leaves money on the table. We want to maximize return for investors because we are the largest investors ourselves.
Yeah, makes sense.
On this deal, like that's why we have the 30-year term, right? So we're under no constraints from our lenders. We have a 30-year term on this note. So
yeah,
we can pick and choose.
yeah, especially with what's going on, which is a couple of the questions are around what are you seeing from your bankers in terms of them getting cold feet for refinancings and recapitalizations and just the environment that we're in right now, which will probably resolve itself. I'm an optimist.
It's funny you mentioned that, Arthur. We literally did a $10.5 million refinance today. Just closed about 2 hours ago. So it's slowed a little bit, but we're not overly concerned.
Yeah. Yeah, just
if we were merchant builders that we have to build and sell, that's a problem.
right.
Build a home. That's time.
Yeah, and I'd say just on these 2 projects, in both cases, we've got very strong local lenders who know and are committed to the market, in Needham Bank and Cambridge Trust. So Revere is a strategic priority for them to build their portfolio. They know it, they're local, we know them. In the case of our development at Sora Revere, that's the same lender that financed 90O, if not mistaken, Needham Bank. And so we have a long-standing relationship with them. They know we're good to get the project completed.
Yeah, and it's good for them too, right?
Yeah.
Meaning
Yeah.
their balance sheet's going to look okay. Okay, so we talked a little bit about this, but we have a question about, current financings. What kind of terms are you seeing right now?
Yeah, so I mean, I guess the most recent financing we did, or here I can speak to our 190 North project, the value add 72 units. At that project with Cambridge Trust, we got 4.4% fixed for 5 years, interest only for 3 of them. So the full 5-year hold that we have modeled here is fixed at 4.4%, with 2.25 floating over a 5-year classic rate for years 6 through 10. So we were very fortunate. I think part of it is that we're known locally in the market, and that we work closely with CBRE on bringing in our debt in these projects, and they know us very, very well from a number of previous financings. So this being the most recent one in September of 2022, we were very fortunate to get a great deal there, we think.
Yeah, that's a super deal for sure. Yeah, there's being close to the market and knowing, it's the same old story about real estate, right? If you don't really know what's going on, you're wondering who the guy that's going to get screwed. It's probably you, right? Yeah, super cool. So yeah, thanks for doing this again.
Appreciate it.
Can you go back to what this? I'm fascinated by what that parking lot looked like, that people actually walked across the bridge to get to the city. It was massive. I thought it was one of those staging areas for the car dealers, but people would actually.
Yeah, the seaport it's a pretty crazy story what we've seen happen there over the last 10 years. Absolutely. I was there just
Actually, 30 years ago, we didn't even call the seaport. It used to be just South Boston.
Yeah. Oh yeah.
Parking.
No, that's right.
Parking area. It wasn't a community.
That's a whole branding thing. This concept of seaport as a neighborhood.
It was industrial.
Call it South
with parking and warehouses, and that's what it looks like.
Yeah, we had our friends from Cisco Brewery in Nantucket do a pop-up at the seaport last year.
I remember that. Yeah, it's amazing the programming that they've done there, and I think part of that's WS Development's done a great job around Seaport Square, and fully would anticipate HYM pulls a page out of that programming playbook and placemaking playbook with Suffolk Downs. We're already starting to see the makings of that they get it, that you don't just build the building and walk away. If you're the master plan developer, you create a sense of place that draws in more people around you.
Yeah, totally.
What's important to mention is the rent prices in Seaport. It's so unaffordable that many people are driven out of it right now in exchange for something more that's better value for money.
It's unbelievable how quickly that's occurred too, where it used to be Fort Point, brick and beam loft was kind of an affordable, kind of edgy place to live, and now in the Seaport it's $2 million condos, and $10,000 rents are not unheard of.
And the Back Bay is more expensive.
Yeah, I think Back Bay in that case, Back Bay has some real expensive luxury buildings that are in Back Bay when you look across Commonwealth Avenue and Marlborough Street. Yeah, Back Bay's been at the top, I think, for a while in Boston.
Yeah. Super. Well, thanks for doing this again, guys. We'll make sure everybody's in touch with you and vice versa for the groups.
Yeah,
the groups
that would
around
be
here.
great.
And then, so we got 400 on one and 2.3 on the other.
Yes.
And you can do both if you want, put a little bit in each, right?
Absolutely. Yeah, we have at least 3 or 4 investors have done so, and they're different stories and they serve different purposes within a portfolio. So certainly makes sense.
Yeah, great. Well, I appreciate it again. Thanks for you guys rallying together there. It's good to have you. And like I said, anybody on the call that wants to be in touch, we'll make sure there's a way to do that. And if there's anybody in your colleagues or otherwise your community that would benefit from knowing about this, please feel free. And we encourage it, of course. And hopefully we'll have you guys back again at some point. But in the meantime, we'll make sure the prior group and this group as direct touch. And as I said, we'll post this and we'll give the file to you. Hopefully you'll post it somewhere so we can send people to your website rather than Family Office Insights.
Will do.
Which makes more sense. And then as I always say, thank you for spending with us. The only thing you can't make more of, and that's your time. So till next time. Thanks, guys. Super.
Thanks,
Thank you, Arthur.
Okay. Bye-bye.